We are back, basically. Brian and Shawn are back to start hosting this monthly webinar series, which is really just an expectation of what you can expect and what's happening on the mortgage side of things. As some of you may or may not be familiar, Brian Stevens with the National Real Estate Post is an expert and is always got his finger on the pulse of everything going on in the mortgage industry. Shawn Kerley is a regional vice president with a company called USA Mortgage and has hosted a lot of these with Brian, and also has a finger on the pulse of what's happening in the industry. I, on the other hand, have no fingers on any pulses unless it's to do with this back here. So I'm just here to introduce these guys in. Obviously, I have a lot of familiarity with the industry, so Shawn will stick around until Brian gets here. But I'll let you go ahead and kick this off with the $1 million question. What can we expect in 2025 as far as it relates to interest rates? And Shawn, I'm going to throw a curveball at you too, by the way. You didn't expect this, and I'll repeat it when Brian gets here. There was a headline this morning from a hedge fund billionaire, Bill Ackman. You see this? Predicts that Fannie and Freddie will be released from conservatorship within the next 2 years. Let's wait for Brian so I can repeat that statement real quick. Brian, welcome. So I just got done welcoming Shawn. Brian, I've already welcomed you, or I've already introduced yourself. And here's how I'm kicking this off before I get in the background. First of all, unmute yourself, Brian. Good to see you again. Couple things for today. Obviously, just kind of a general prognosis and general predictions of what to expect for 2025 as it relates to the mortgage industry. Obviously, interest rates, but I went ahead and threw out a headline from today, which was the hedge fund billionaire Bill Ackman predicting that Fannie and Freddie will be gone in the next 2 years. So I'm going to let you guys take it away now that I've set the table.
Well, Bill Ackman has a long, rich history of betting shorts and failing miserably at them. So with that said, he's got a lot of money. He's got a great hedge fund, but his predictions and prognostications over the year have not been great. Hence, Mona V. Here's my thing. I think what's going to happen in this industry, what we need to see happen, is going to be something that's very simple that seems kind of counterintuitive. What we need to do is we have to have a correction. Like, we are still, bloated with loan officers and real estate agents. A loan officer going forward or a realtor going forward is going to have to be way more on their game than they were last year or the previous year. Like, gone is the whole idea that you can pick the low-hanging fruit from 2020. I think everybody understands that. We've already lost that. But to truly succeed at loans and real estate going forward, you're going to have to be on the top of your game. You're going to have a lean model that works for you. You're going to have to get rid of middlemen. And the truth of the matter is if you want to find out who's succeeding, go talk to a successful realtor or go talk to a successful loan officer, not somebody who hasn't written a loan in 20 years. Like, right now, writing loans has never been so easy. With all this godforsaken technology that we have, it's made things really easy for us to do. So our job is not to go out there and process paper. Our job is to go out there and find somebody who wants to buy a house in our community and get in the middle of that conversation. If we understand what our job title is and really look at that as a profession, then we will succeed, and we will succeed gloriously. But those who don't understand what their job description is are going to be people who fail. Now, you brought up, rates. So rates are what rates are. So, me and Shawn, we're selling the same rate. Different states, different overlays, but basically the same rate. The question then becomes, who is that person going to work with? Are they going to work with me, or are they going to work with Shawn? And of course, this is arbitrarily. It could be anybody, right? Like, what are we affording our clients that other people simply aren't doing? And if we could solve that riddle, then we could find a way to succeed. But that's what it comes down to. Writing loans as a discipline is the easiest thing in the world. It's filling out a Mad Lib that we used to use when we were in 5th grade. They're not hard. What we have to do is we have to understand the nature of people, and we have to get in the middle of more conversations about real estate. And when that happens, it doesn't matter where rates are at. It doesn't matter what prices are at. The two things that we can kind of have a little bit of control over. But here's the interesting thing, guys, Jeff, Shawn, is we're coming out of a market where it's perceived to be a high interest rate environment. Yet the interest rates that we've been selling over the past year are relatively normal if we look at the scale on a long enough timeline. They're not high rates. They're just realistic rates right now, where we have all of our politicians and all of our bureaucrats getting their hands out of real estate and letting rates fall where they are. Like, I know that Fannie and Freddie are prognosticating that rates are going to come down by a point to a point and a half over the next year. But let's say that doesn't happen. Is that going to be the death sentence or the death rattle for either one of us? And the answer is no. Are prices going to come down? There are people doing extraordinary things and building houses right now that are bringing prices down. I mean, absolutely extraordinary things. But we can't control those two things, can we? What we can control is the people who are interested in buying houses. What we can do is be salespeople. And what a good salesperson does is get somebody to come to a conclusion that's financially going to benefit them. That's it. And if I can sit down and belly to belly with somebody and have a conversation about that on those terms, I feel like my ability to persuade, which gives me autonomy over my own personal business, then goes up tenfold. So the market that we're going into, even though some of it, some people see it as doom and gloom, what it's doing is it's giving me autonomy to go ahead and make decisions that are actually going to affect my life and the people who work with me and around me.
Yeah, the fun thing with this friction that we felt for the past 3 years is everybody had a license. It seemed like there was hundreds of thousands, millions of realtors, hundreds of thousands of loan officers, whatever. And I don't know the exact stat because we just finished up through renewal on the mortgage side, but I think there's like only a third of licensed loan officers
Yep.
left. And the 2020, 2021 order taker years really had made, I wouldn't say lazy, but got people out of the belly to belly, like what you're talking about, Brian. And now a lot of folks have vacated the space because it is hard. It's harder to have more conversations, take more applications to yield that one funded loan or help that one family. But everybody, every time the phone rings, if it's a client, what's your rate today? What's your rate today? We hear that so much. And a lot of the folks want us to look into a crystal ball and say, well, what are rates going to do this year? And I mean, it does change report by report, day by day, month to month, whatever what rates are going to do. I wanted to show a couple things of like what the mortgage-backed securities bond market's doing and what some of these folks are predicting. And most importantly on, well, I heard the government or I heard the Fed cut rates, why aren't the rates going down kind of thing? And we can kind of explain that a little bit just to let people know anybody that's talking may have a little bit, feel a little bit of a pulse, but we really don't know what's going to happen,
No.
12 months from now, 10 months from now, even 60 days from now. There's so many factors that happen that really make the markets move positive or negative, depending on, what your outlook looks at. So I'm going to share real quick. And you just
And
look
while
like,
you're doing that, I want to intervene here real quickly. If you were to put Fannie Mae and Freddie Mac together as an individual company, which they basically are, and you were to look at their profit margin over the past 80 years, it's 80 years, they are the most profitable company in the history of the world.
mhm.
More than Apple, more than Chevron, more than BP, more than IBM, more than anybody. Now, I've got to assume, Shawn, I think you're a pretty smart guy. I do.
Well, thank you.
But you know what the truth is? I think they can hire smarter people than me and you. And Fannie Mae and Freddie Mac have the pulse of what's going on with the Fed, with the Treasury, with all their economic policies. They know what's going on over in London. They know this stuff better than us, and they hire the best people. They came out last year and said, here's the rate prognostication for the next 2 years. And they're going to be at 5.5% by the end of 2026. And then they came out 6 days later and said, oops, nope, my bad. It's going to be this. Now, if they can't figure it out, me and you, we need to figure out something that works for us, because if we can't trust them, then who in the heck can we trust?
And what is the bond market doing? And all this is basically companies, governments, businesses, or countries purchasing mortgage-backed securities. And the lower that this goes means that there's less appetite for people to buy our debt, our mortgage-backed securities debt. The higher it goes means that people are buying it or organizations are buying it, and it relieves the pressure for higher rates. So we want this to go as high as possible, just to basically allow rates to come down. The problem is that like on this September 18th, the Fed cut 50 bips. We're like, hip, hip, hooray, we got a 50 bip rate cut. Now, whenever they cut rates, that's short-term rates. It doesn't directly affect mortgage rates, but it will relieve pressure to where mortgage rates should follow in days, weeks, months to come. So they cut rates here. It really didn't move the needle, but then we started losing a lot of attractiveness, like a lot of big sell-offs for this debt. And whenever you see these big red candles, there's pressure for rates to go up and up and up. Now they did cut last year a full point off of the short-term rate. The Fed did, but on December 18th, they cut another 25 bips that equaled a full point cut, but we had a huge sell-off. Now I'm going to pull something else over here. Before December 18th, they put out, realtors said at the end of 2025, we'll be at 6.2. NAR says near 6%. MBS Highway, which I subscribe to Barry's technology here, him and his team were saying 5.75. So like, all right, sweet, we're back in the fives. Helps affordability because home prices, they're not going down. There's so many new household formations that keep on adding. And we don't have the houses to supply. So therefore, the prices are going to continually keep on going up. But what happened on the 18th for this right here? They cut rates, but we had a huge sell-off. There was a thing called the Fed dot plot. And all this says is that you have 16 or 19 federal members that vote on what are we going to do with the rates. September 18th, you had a lot of cats saying we're going to cut in 2025 at least 100 bips or 125. But on the 18th, all these talking heads said, we can't cut this much in 2025. We're only going to cut a half a point, or that's what they're basically forecasting, is that we're not going to cut nearly as much because inflation is coming back. Now, inflation is a 12-month rolling average. November of 2023 fell off, which was a super sexy number, got replaced with a little bit higher number. Inflation went up. Now you have talks about what the new administration is going to do that could be inflationary or whatever. So now the Fed is moving. You're like, oh my God, we don't have inflation under control like we thought. So therefore, we're going to still see some pain in the markets, and that's going to basically keep rates a little bit higher. One thing that we want to look for is the labor market. And, if things are going bad, if stores are closing, it doesn't really back up our economy's rip and roar and everything's kumbaya. If you look at all of these stores, and these are stores, these are not employees, like Party City, 850 stores. Walgreens, 1,200 stores closed. And whenever you have a store, it's just not one employee. There are multiples, if not tens, if not hundreds of employees with all these stores. Whenever we see these closures, the labor market, if it cools, then you're going to see that there's going to be a little bit more of attraction to reverse the role on, okay, instead of 50 bips, now we need to go 75, 100, or back up to the 150 market. I don't ever want to, say, hey, I want people to suffer or I want people to lose their jobs. But this is one of the factors that will affect the interest rate when it comes to our business, to where if the economy is not as strong as what they are talking about, you'll start seeing a reversal with the Fed. And they've kind of changed their ways to where they're moving a little bit quicker now compared to where it was just a wait and see approach. I don't know. What are your thoughts on that, Brian? What do you think might?
Can I screen share?
Yeah, of course.
All right, here we go. If you want to find out where rates are going, let's see. Hang tight. All right, if you see something on my computer that you find offensive, I'm just pulling this up as we're talking. All right, here's the Fed balance sheet. So when we talk about the Fed fund rate, we're talking about short-term money, how banks borrow money from each other. It does not have a direct correlation to what rates are, or does the T-bill. They don't. They're good indicators. They'll kind of give you an idea of the direction rates are going. But if you really want to see where the rubber meets the road, it's what the Fed decided to do when they decided that they were going to be the only systemic borrower of mortgage-backed securities. And this is the Fed balance sheet that you're staring at here. And we went from billions to trillions. And again, we've talked about this before, Shawn. The difference between, a billion seconds and a trillion seconds is 22 years and 22,000 years. The numbers are staggering. So when we saw this big bump and we saw this, what was going on is the Fed was going out there and they were increasing their balance sheet. And that's what affected rates, because when they're consuming them, they're creating an artificial market for something that didn't exist because nobody in the private sector wanted to buy them. So the Fed was going out there buying everything. Now, what they've done is they've decided that they were going to get out of the mortgage-backed security buying market, and they were going to let the private sector jump in. When the private sector jumped in, well, then rates went up because people didn't want to buy at 3%. They want to buy at 6%. So we're feeling the pain from this going down and the Fed lowering their balance sheet. But here's the truth. The big problem is inflation. Now, I don't know if you guys know this, but inflation has been reconsidered what it is. It does not consider your housing cost, and it doesn't consider your energy cost. Well, what do you spend more than on housing and filling your car up and putting the lights on in your house? Those aren't factored into how we currently, the algorithms that we're using for inflation. But inflation is basically a pay decrease for everybody. And what we're doing is we're feeling the hangover of this. When we had cheap money, we saw this in Britain and the United States in the 1980s, in the late 1970s. And then what we're feeling right now is we're feeling the hangover of cheap money, because ultimately everything catches up to what we have to spend. And that's why, when I hear these inflationary numbers and I go to the store, it's not reflective of what the numbers are when I hear things are going great. When you feel things are more expensive for you right now, there's a reason for that. And it's because they've changed the darn algorithm. So rates, are they coming back to what the market would allow? And they certainly are. But Shawn, here's the most important question I have for a realtor or lender. Does it matter? Because right now, Shawn, how old are you?
47.
47. So we're in the same. I will be 53 in a couple of days, and I can tell you right now, there's a 47 to 53-year-old guy right now who's going to go spend $120,000 on a brand new Corvette with that mid-engine thing that's really sleek. It's going to be $150,000, and he's going to pay 14% interest on it. You want to know why he's going to do it? Because he deserves it. He deserves it. That's why he's going to do it. He's going to get the racing gloves and the glasses and all the bullshit, and he's going to go do his thing. If somebody's going to spend 15% on a stupid car, and sheet metal does not pay returns and dividends, that thing loses 20% when it drives off the lot. If you're going to spend 14% for that, why aren't you going to spend 7% on a house, something that's actually going to appreciate? We fail, me and you fail, when we don't let people know that these are the better options for them. I just had a conversation with Dave Savage. And by the way, Barry's thing that you put up there with MBS Highway, I trust that more than I trust anything else. Barry's stuff with MBS Highway is absolutely fantastic. And he's got a great system for loan officers to jump into. Mortgage Coach, again, I have no dog in the fight on this one. But what they talk about is where are you going to be in 10 years? Like, here's my thing, Shawn, is if somebody's owned a house for 6 years, they're sitting on a boatload of equity that's not being used. That's a fact. It could be in Missouri or California. It doesn't matter. Now, if somebody were to come to you and say, hey, I just hit the lottery, your grandma just croaked, and I just got $100,000, what should I do with it? You would say, buy a house. It will pay dividends forever for you. And a long enough period of time is going to prove that point out. Well, you and your pipeline right now, 45% of the people that you have in your pipeline are sitting on that winning lottery ticket. Why are we not having conversations with our clients and saying, why don't you double your real estate holdings right now when things are a little bit softer than where they were? Now, the difference between this market and 6 months ago, I want you to pay attention to this. This is really important. At least where I live in California, you're going to pay 10 to 20% higher and get nothing from the seller. Now, 10 to 20% higher, the median sales price for a house in Vacaville is $750,000. So we're talking about $100,000, $200,000. Okay, if I were to buy that house at the top of the market a couple of months ago, I would have a tax bill that's going to be $200,000 higher than what it was today. In fact, it's better to sell a house in a slow market and buy a house in a slow market than it is one that's escalating. Because the only thing that's going to hold true, it's not going to be the percentage you're putting down. It's going to be the tax bill that you have to pay in perpetuity. So we have great selling points in our business. We do. And what we need to do is we need to arm our real estate agents and our loan officers to have better conversations. Don't look at the pool of people who are saying they're going to buy a house today. Look at the pool of people who can buy a house today, but just simply don't know it's an option on the table for them. You have 25% of the people in your pipeline right now who could and should buy a house if only you were to get in front of them and show them the math. And we have ample opportunity to do that. Again, 2025 is going to be defined by loan officers who are, Shawn, you know this better than anybody. are going to get more creative, like with what they're approaching. Is this harder? You bet your ass it is. Is this more difficult? You bet. But you're paid handsomely on these deals that close. You're not hot mopping a house in June out in Arizona. You're selling a loan. But what we have to do is we have to become more professional. And when it comes to these numbers of attrition, guys, I'm telling you right now, bring it on. This is a market that's meant for people like me and you who look at our profession as a true discipline. And it's going to bring more true professionals out. And I, for one, love it.
Yeah. I remember back in 2010 when things got really, really difficult, we had a lot of people get out of the business. And if you're doing a good job, the benefit is that you're just picking up market share. And whenever it turns around, then you're like, holy hell, I need more hands on deck to help me scale at the levels. Now, I do appreciate you saying kind of things about Barry. He is putting on a webinar next, the 6th. I'm going to put the link in the chat if you guys want to register. It is free. I would highly, highly recommend you share this with any of your folks in your office to go ahead and jump on it. It's just Barry coming in on his team and talking about what he thinks. Brian and I, we really respect what Barry and his team do. And again, his technology is on one of my screens each and every day, every minute of the day, actually, just watching what's going on. So if you want to register for that, I highly, highly recommend. But
Yep,
getting
I agree.
creative, I remember back in 2010, I started doing a lot of rehab loans, 203K loans, FHA product. The reason why I say that is that Fannie Mae came out and said that their foreclosures that are going to be hitting the market in 2025 should be up like 400%. I forget the exact stat, but there are more properties that should be hitting market that haven't been hitting, because of all the fun rules that we were dealing with during COVID, where nobody had to pay a mortgage for 2 years and not have any repercussions. Now these homes are going to start hitting. Will some of them be dilapidated, not taken care of, whatever? For sure. But there are loan products out there for people that have a vision to where if they can pick up a house and then do a little TLC to it, now they have a beautiful asset, a beautiful home that they can live into. So getting familiar with home style 203K rehab loans as a real estate agent and also as a loan officer would be imperative. And you'd just be missing the boat in this niche for sure.
I'm going to go further. I personally, I like turquoise shag carpet. I'm all okay with it. Grandma's carpet is good for me. But what we're dealing with, Shawn, is we're dealing with the biggest migration of wealth in the history of the world right now, from the boomers. And it's my mom. I'm not making light of this, but it's my mom. It's your mom. And we're seeing the biggest amount of wealth being transferred over to different generations who are going to deal with that in different ways. The ability to go into these houses right now and do that, armchair equity type of thing is huge. And for what I believe and what I'm seeing in my own personal business is you as a loan officer and a realtor, as a loan officer in particular, you need to get off the reservation. You have to start doing things that other people aren't doing. It's in numbers. Like, fewer people in one area that we can go ahead and lend money on is going to give you a disproportionately high opportunity to benefit from that. And if you were to go out there and look at the numbers with the rehab loans that we're going to deal with, our Gubby loans, our Jenny notes, and our conventional, yeah, I mean, they're going to say, well, there's not a lot of meat on that bone, but the meat on the bone is going to be filled from those who actually go seek it out. And there's a huge opportunity with it, particularly right now. Everything that we want to do is we want to read the market and figure out where the opportunities lie. And the opportunities with our 203Ks are massive. They're absolutely massive. And you as a realtor want to work with somebody, a loan officer who understands this. Because, we can all dust it off and figure it out and do it and make that whole transaction miserable. Or we could be somebody who is a true professional who goes out there and understands how to get these things closed in a reasonable time. And it's a massive, massive opportunity. It really honestly is.
Yeah, and for folks that have 4 units in their markets, if you're having the first time home buyer that got left behind, the FHA product for a 4 unit is amazing to where you can use the rents and the 3 other units to help them qualify. There are products out there that will allow even folks to succeed in this market. And I'm always, I wouldn't say shocked anymore, but I'm pretty damn proud about how resilient the real estate market is. Real estate side, mortgage side, we always figure out a way. I mean, again, I don't want to be, would you call it, wet mopping it in August or in Arizona? I don't want to do that crap. I want to stay in this business, and we'll find a way to figure it out. But for the folks that have survived through the last 3 years, and seeing a lot of friends or a lot of competition go by the wayside, they can sell the Verizon phones at the mall. Perfect. That means that you have much more opportunity because deals are still going to be done. Money never stops moving, and so just keep on working. But yeah, belly to belly for sure.
I live in tech country USA, the Silicon Valley. I can hit it with a rock from where I'm at. And it is driving them mad that they can't take over the real estate industry. But here's what they can't do. They can't look down the benches on a Friday night and say, "Hey, Bob, how's your kid doing?" "My kid's doing all right, Brian." They can't do that. Like with the numbers that we are still fundamentally at our core a belly to belly business. And other industries actually prove this to be true. You could look at the travel industry right now, and even like your Gen X, Ys, and Zs, or whatever the hell they call them these days, the younger generations, if they're going to go overseas, they're going to deal with a travel agent because they want to make sure that that massive investment is going to be taken care of responsibly. If I'm going to fly to, St. Louis, Missouri, I'm just going to go on Travelocity. But if I'm going to go over to South Africa and go on a safari, I'm going to spend the time to make sure that I have a great time doing it. Our industry spends more money than any other industry, and what people truly want, even the younger generations, are true professionals who can help them through that process. Not only are we not going away, guys, with all the automation that we have, for those who succeed and those who understand what their job description is, these are going to be great years in front of us, and other industries prove it out.
For sure, for sure. Well, we're right at 30 minutes. Anything else you want to talk about?
I got a couple of jokes. Do you want to hear them?
Yeah, let's hear it.
No, hey,
But
listen, this honestly, this year is like with your business right now, you just have to say it wasn't 2020 anymore as a loan officer or for a realtor. You could build your team, you can do what's going to succeed. There will be attrition, but if you are true to your clients and you have their best interest at heart, you will find a way through this. But that is fundamental, and it's easier, my friends, said than done.
yeah, yeah. It was interesting you talked about the fictitious gentleman buying the Z06 at $130,000 or whatever it
Yeah.
is. I read a report that the car industry is expecting 2025 to be the best year in the past 9 years. I was like, how is that possible?
Do you want me to tell you? Oh
Yeah,
no,
go.
let me tell you. Here's why. I had a client, his name was Jason Halstead. Okay. So Jason bought a whole bunch of houses for me. He was a young kid at the time. This was 20 years ago. And Jason always wanted to be me because I had a job that was making more money. We both dealt with finance. He was dealing with car finance, I was dealing with house finance. And he would come in, great guy, super cool, and we had like that just personal connection. In 2008 and 9, when the housing market hit and everything went to hell, Jason bought more houses. He bought like 5 houses in 2009. And I said, "How the hell are you doing this?" He goes, "Here's how this whole thing goes, Brian." He goes, "When people can't pay their bills on their house," he goes, "they'll still pay on their car because they have to go to work." He goes, "And if you come to me and you can show me 6 months where you've made your payment on your car, you're going to do it. So when that house gets foreclosed on," he goes, what's the first thing that most of these guys are going to do? Their egos like just in shatters. He goes, they want to go buy a brand new car. And when they come to me, they can get the financing on it. He goes, "You can't sell houses right now." He goes, "I can sell cars all day long. Now you want to be me." That's what's happening right now. And this should be a lesson to everybody watching this right now. That truly is the canary in the coal mine. So if people start losing their houses, as all the numbers indicate it's going to happen, is that a good or a bad thing? I guess it depends on where you stand. When a house is now available to be sold and I'm the person who's selling money, I like my odds because I can control that outcome. So when you read things that you perceive to be negative in the news right now, just understand your role in this whole thing. You're providing solutions to where it seems to a lot of people they don't have any.
Yeah,
That's why
very-
people are buying cars. And that's exactly what's going on. And this, for people like me and you, is going to be a great year for us because we can provide sound financial solutions for people. We're not just making money stupidly. We are going to give people great rates, great products, great loans where they own homes. I look forward to this year.
Me too. Me too.
Thanks,
Jeff, what do
fellas.
you have to add?
I just came back for the jokes, and then you guys let me down. So,
I gotta tell you those off air. Actually,
fellas,
there's a guy on Netflix right now. I was watching this last night and I said, "Who the hell is this guy?" And like the stadium was filled. What's his name? Nate Bargatze. And the guy is telling dad jokes. There's not one offensive word in the whole thing. And I'm like, "Oh, this guy's a dud." And I watched him for like 10 minutes, and I got to tell you, his stand-up is solid. So if you got nothing out of this conversation, check out Nate Bargatze on Netflix. Pretty funny, super clean. You can watch it with your kids.
Nice, nice.
Love it. All right, fellas, we'll see you. We'll see you next month. Hopefully, the good news continues, the positivity continues. Thank you guys for being on, and we'll see you next time.
Sounds good.
Bye-bye.